Hello, I'm Robert and welcome to my channel where I discuss everything automated algorithmic trading or simply algo trading. Today is going to be a bit different though. I've gotten a large number of questions on how to even begin trading. So I really wanted to talk about that topic because trading is fun and it is really something that can be entertaining like any other hobby if you have the right information. So we're going to use any platform that you want. It really doesn't matter. I'm going to demonstrate through Oanda because I have found that their demo account is one of the better ones, and so far I have not found anyone that cannot sign up to one of their demo accounts. So you want to go specifically to this URL, oanda.com/apply/demo. That URL will take you to the demo account process. Go through it, fill it out, so forth. Demo accounts are free. You will not be charged a single penny for this account, which makes it wonderful. Now you can use any broker in your area as long as it has a demo account or a paper trading account. This is always the first step. At this point, if you're just learning to trade, don't use real money. Do not, I repeat, do not sign up for a live account. Only a demo account. So now, once you go through the process, and they'll ask you some information that you'll need to fill out, you'll go into their charting platform. Now, because I use a tablet, I use the mobile app. So that's what I'm going to bring up next. Now that I'm in the mobile app, you will see something like this on your screen. Whether it's the web page, your phone, or a tablet, you'll get something similar to this for Oanda. Now I've done an overview of Oanda, which is a very basic one, and I'll try to remember to put the link in the description. But I'm going to go through a lot of this now for a very simple overview specific to learning how to trade. All of these up here, these are your assets or instruments. The words really don't matter. A lot of people just call them pairs. These are what is available to trade. The items that have red glowing bars, that means the market is going down. Green glowing bars means the market is going up. Now going down means they are losing money. Going up means they are making money. At least that's the theory. But realistically, it's much more complicated than that. So we're going to really go through and talk about some of the most basic functions of what you can do with this program. You are going to be able to actually buy and sell an asset. Now, in order to clean up the screen, if you click on these little symbols, it collapses it. Over here, you can drag this one, and as you can see, it closes it down. So now we have the chart. The chart is where everything happens. This is where you make your decisions to buy or sell, to open a long position or a short position. Now, a lot of those words really don't matter at this point. You're going to hear them over and over repeatedly throughout the process of learning to trade. And for Oanda, it gives you this little side cut screen that tells you what the selling price is, what the buying price is, and the difference between a selling and buying price, or what is called spread. Now you'll notice that the buying price is higher than the selling price. That is meant to be this way in trading. A lot of times you'll hear people say you're going to pay for the spread. For Oanda, you don't physically pay for it. You just have your trade increased or decreased appropriate to that number. And that number has its own weird terminology that we're going to cover next. And that is what's called pips. Now a pip is nothing more than 0.0001, or 1/10,000th of a penny. Now imagine saying that all day long. As you can see here, how the numbers actually look. 1/10,000th of a penny is a pain, so the marketers simply shorten it to 3.5 pips. So you'll notice that this number is in 5 digits after the decimal. If the first 4 digits equal a pip count, the 5th digit refers to micropips. Again, don't get hung up on the language right now, because you're going to hear it over and over. And that's the whole point of what this is about. Getting used to the terminology through practice. You see, there are hundreds of thousands of books, videos, seminars, webinars, whatever. But until you actually use a demo account, until you actually try to buy and sell through a demo account, none of that matters. It's all just gibberish. So what I hope that you gain from this is just how important a demo account really is, and how to really begin practicing on trading. Now let's start with some of the very basics. The candle. This is a candle, this is a candle, this is a candle, this is a candle, and so on. Now you'll notice there's red candles and green candles. They don't have to be red and green, but this is the standard. Green candles show that the price closed above the open. A red candle shows that the price closed below the open. And that is our next step, the actual prices. So if you click, you will get this fancy little bar. You see the wick or upper shadow, a wick or lower shadow, the thin lines. Those are the high for the top, the low for the bottom. And you see down here what the low value was, low value, high value, opening value, closing value. Now because it's a green candle, the closing value will be higher than the opening value, meaning price went up. Now the high value, or the wick if you see up here, that represents how high the price went. But because the candle didn't close at its highest value, that's why it's a thin line. The same holds true for the opening value and the low value. How far did price drop? And that's what this wick represents. Now these wicks are important to a lot of traders because they tell traders how much the bulls and the bears actually pushed against each other, trying to drive price up or down. In the market, a bull is somebody that wants price to go up, and a bear is somebody that wants price to go down. The tug of war between the bulls and the bears is what keeps the price fluctuating. Bulls want more money for the value, bears want less money for the value. You'll often hear this being described as supply and demand, or overbought and oversold. The bulls and the bears are always at this tug of war, keeping price balanced. If price goes too high, it's no longer worth the value of being paid for. That is, it's oversold. If price goes too low, it's overbought. And price fluctuates back and forth between the two segments. So when you're moving back and forth with the market, and these tug of war continues between the bulls and the bears, that is where opportunities take place to buy and sell appropriate to the direction of the market. For example, if you believe the price will go up, you will enter into a long position. If you believe the price will go down, you will enter into a short position. And that will enable you to be able to actually profit if the market moves in your direction. So now let's look at the red candle. And you'll see that the opening price is higher than the closing price. So that is, the value went down. Now, open and close are all determined based upon a time frame. In this case, the time frame is a duration of 1 week. And there are multiple time frames to trade from. What time frame you pick really doesn't matter, except that the longer the time frame, the longer the spacing between your trades. So if you're looking for short time frames where you can trade rapidly, then you're scalping. If you're looking for medium time frames, say like a 1 hour, then you're swing trading or right at the border of scalping. Again, it depends on your style. If you're looking for longer time frames, 12 hour, 1 day and above, then you are investing more than trading. And sometimes it's still called swing trading. Sometimes it's called position holding. There's a lot of different terms that go on with a lot of these different situations. Again, don't get caught up in the terminology. Focus on the basics of your learning with the demo account. So for now, we have the basics. Now let's go and look at a smaller time frame. Let's look at a 1 minute chart and actually see the market moving. And after 1 minute, you see the market will open up a new candle. But right now, this candle is open. And we can see that the price is fluctuating up and down. Okay, the market closed and opened a new candle. And this is basically how trading really works. Back and forth, the prices continue in an up and down pattern. As a trader, we need to interpret this information to try to figure out how to get into the market. Now, right now, I have this market zoomed in really close, but we can actually take and shrink it by pinching the screen and actually get a bigger picture of the market. And we can see where the market has been, where it is gone, and ultimately where we believe it might go next. Now, as you can see right now, visually, the market looks like it's going downward. We had a little bit of gap here where it went sideways, but then it started going downward again. So a downturn market is suggestive of opening a short position. That is, we think the price is going to continue to go downward. The beauty of a demo account is you could try this and not risk any money whatsoever. And that's what really makes it nice. You're not risking any money. And your demo account will usually come with a very large amount of play money where you can actually test and see and even reset the account should you blow it up, which you really want to blow it up. You want to actually go through the process of making mistakes here. You see, in the world of trading, 90% of all traders lose 90% of their money in the first 90 days of trading. And a lot of that can be avoided if they just spend time in the demo account. And you stay here until you learn how not to lose your money. And you're able to develop a technique that will help you make money. Do not enter a live market until you understand how to actually trade. There's no time limit here. You're not rushed to make trades. You're not rushed to hurry up and learn. Take your time. So we're going to focus on looking at this market. Now, because the market looks like it's going to go down into a short-term process, we're going to open a short position. So let's zoom back in by spreading the screen a little bit. This is no different than your Android or iPhone. And now, short positions. We want to click on the sell side. And now, it's going to ask us some information. Now, the dotted line, this is where we're actually going to get our purchase. That is, this is our spread. This is what is going to determine what price is actually bought at. Now, some people say you pay for the spread. But with Oanda, you don't actually pay a physical fee with it. You just lose that much on your market, meaning your price is lowered that much. So if you're smart, you'll write this number down and then you'll factor it into your profit. That is when you go to sell it. Now here we have the choice of how many units. On Oanda, a unit is one of this value. So, one of $1.65 for this asset. So, if I purchase 10 units, I will be purchasing roughly $16 of this asset, which is fine. Now, I'm not going to go into the leverage or anything of that nature yet, simply because we want to keep this simple. And everything on most Forex exchanges is leveraged. That's fine, no big deal. We're not going to worry about that now. We're going to keep it simple. But you can see here, the program tells you what 1 pip equals in dollars. It tells you what your trade value will represent, and it tells you the margin requirement. Now, a margin, for example, might be 20 to 1 or 50 to 1, so forth. So basically, a margin is the amount of units times that number. So if your margin is 20 to 1, then that means if you want $10, well, you can figure out what that is. For example, 100 units times 20. That would be 2,000 units, for example. But this is where you learn. This is where you type in numbers and you see what it produces. So let's start reasonable. And let's just do 100. So we have 100 units. And that tells us now that 1 pip is worth 1 penny. It tells us that our account will need to use $3.16 of margin. Now this is important because if you go here and click on this part here, this is your margin used. This little white line is what's called the liquidation point. You can't go above 50% of your account balance without it being margin called and liquidated, or what's called a margin closeout. So that is how you actually protect your money. You should stay relatively low. Don't get close to 50% of your balance because you could end up losing your money a lot. Now just simply click on the little blue bar and drag it back. So $3.16. Let's change this to 1,000 units. So 1,000 units now means I use $31. And 1 pip is now equal to 6 cents. Remember, 1 pip is 1/10,000th of a penny. So every time the price moves 1/10,000th of a penny, it will either make or lose 6 cents of real money if this was a real account. That is what demo trading is for, to help you decide what is and is not appropriate for your own personal risk. So now that we have the margin units figured out, we're going to go with this. Now we need a take profit, a TP. This is where we want our position to be sold or closed to earn money. So let's go ahead and set the take profit. Now, we know where the price is. Now we can simply draw on a screen, and I'm going to see if I can put this around 10 pips. Now I'm just dragging this bar till it gets to where I want to have it take my profit. Okay, close enough. So if the price goes down to there, we are going to make money. So 10 pips times 6, we're going to make 60 cents if this makes it this far down. Now we're going to set a stop loss. A stop loss is often used in the market for people to get out of the market if the price goes too far down. It's like a safety net. So we're going to set a stop loss. If the market goes against us, we don't want to lose a lot of money. That is the first thing we need to do in learning how to trade, is learning how to keep our money as much as possible. Now, you are going to take losses along the way of trading. There's no way around that. It just happens. That's why the demo account is so important. It helps you deal with the psychology of losing money, because you are going to lose money. Realistically, as you work with this account, you're going to become desensitized to some degree. And that's important because your mindset of trading will be better if you stop thinking about it as much as money, as just numbers. But there's another part of this mindset. Think about trading as a hobby. Every hobby has its price. Every hobby has a certain amount of money you put into it that you know you're never going to get back. If you take trading in the same light, then you will get a much better edge on other people who just see money and don't equate with just numbers. So, think of your trading as a hobby, and that hobby has a price. It's no different than learning how to play a guitar and paying for lessons, or learning how to dance, or pottery, or cooking, or painting. Every hobby on the planet has some sort of price. That price is what you pay for the enjoyment of the hobby. Keeping that kind of mindset will help you learn the two most important rules of trading. Never risk more than you can afford to lose, and always be willing to lose everything you risk. Those two rules are the best rules you will ever learn. And if you don't understand them to the fullest, you won't survive trading. So now let's actually plug in our stop loss. Plug in where we want the program to get out of the market. Now I'm picking numbers that are common for the market. You'll always hear risk to reward, risk versus reward, reward versus risk, or a 2-to-1 ratio, or a 3-to-1 ratio, so forth. What that means is if you want to make 60 cents for a profit, how much do you want to risk? Do you want to risk 60 cents? That would be a 1-to-1 reward to risk. Do you want to risk only 30 cents? That would be a 2-to-1 reward to risk. There are a lot of different things that you will learn over time. A lot of it is going to be just gibberish right now, which is fine. For now, I'm just going to go with a very simple process. 10 pips at 6 pennies a pip. That's 60 cents profit. Let's say I want to risk 60 cents to make 60 cents. So a 1-to-1. Nice and simple. So now let's draw our lines. Okay, let's go up to 10 pips. Now, it doesn't have to be perfect. And you can fiddle with it all you want all day long to get it perfect if you want. Okay, let's adjust this one down. So, now we have roughly 10 pips for our stop loss, roughly 10 pips for our take profit. And so now when we want to place the order, we simply click on submit. And we want to place a market order. And now we've been told we've placed a market order for 1,000 units at 1.655 for the price. And that we've used $31 of our margin. So now, that's it. We have a trade. Now we just wait for this trade to happen. It will either hit our stop loss up here, or it will hit our take profit someplace down here. But that is all there is to trading. Trading really is that simple. But there is a but. If it was that easy really to trade, everybody would be millionaires. It's not. Understanding where the market is going to go, trying to figure out how the market is moving, studying the relationship between the euro dollar and the Australian dollar in this case. All of that is part of fundamental analysis and technical analysis. Basically more gibberish that you will learn as you go. For now, just look at the chart, try to decide if the price is going to go up or going to go down, and place a trade. Look for patterns. Look for places where the market tends to repeat itself. That way you can get an understanding of what the market is likely to do. The other thing is look at different times. Different times give you different information. For example, we can see right here, this area seems to be consistent. This area was consistent for a short time. And now we are here with this area. So looking at all of the different times involved can help you gain information that your brain can start to see patterns develop. The demo account is about practice. The more you practice trading, the better you'll get as long as you take the time to learn, to think about why you're trading. Why did you get into this market? Well, for the purposes of this example, I got into the market and the direction because the price is going down. And it looks like it might continue going down. That's why I got into it. But if you believe, well, the price has gone down, and looking at the chart, maybe the price will go back up, then your decision would be a little bit different. And that's the whole point. You learn by trial and error in a demo account. And you learn different sets, different skills, different possibilities. You're going to get hit with a lot of weird terms and a lot of weird ideologies that may or may not make sense to you, but it doesn't matter. You're even going to be able to add fancy things to your chart that might help you see more information. And those are all things we're going to cover in time. For example, I'm just going to pick a very simple process, and I'm going to simply put it on the chart. Let's see if I can find it. For example, let's pick full. Let's add the indicator. And period, how far do we want to move back? Well, the standard market is 200. And it draws us this pretty line. Now, this pretty line gives us an idea of where the market might be. And we can even go further by looking at, for example, $20 and roughly 50. Again, none of this needs to make sense right now. These are all just things you can do, but you don't need to do. And that's really the beauty of it. Trading is about learning. And it's about learning through trial and error. You're not going to be able to just magically get all of this gibberish right away. You don't even need to worry about it. Depending upon who you ask, indicators don't offer any value. Some traders like them, some traders don't. as you progress in learning how to trade through the demo account. Try different things. You're not going to lose any money here. You're not going to break anything. So by looking at the market through these different available tools, you will learn and you will see along the way in a meaningful approach. Trading is fun. It's exciting. But if you do it incorrectly, it can be stressful and frustrating. If you take it like a hobby and you stick to some very basic rules, for example, never use more than 1% of your balance for any single trade, you automatically have built in a system to help you protect your money. Those are things that you're going to read about extensively. But play with the account. Test it. You don't have to wait for this particular trade to sell off to open up another trade. The one thing though I will tell you that it can be quite critical as you do trade is don't go into too many positions because you'll lose track of what you're doing. Take your time to read about each different pair, and then from there pick one and only one that you are interested in. Learn about that pair. Learn about its characteristics, its history, its market, and that will help you become a better trader. The worst thing you can do is spend all your time trying to learn everything and not mastering any of it. And as you can see here, the market is going against us. We might get stopped out, which is fine. That's the whole point of a demo account. That's why we want to go through the process of practicing what it means to trade. Now, as you can see here that there is what's called a zone. Now, zones aren't exact numbers, and this may very well be in that zone. Then again, it might go up above this and then come back down. We don't know. We can't see the future. But as you practice, as you try to buy and sell different currencies or different positions. For example, let's open up another short position. Let's put 1,000 units. Now, we're getting a warning here because on Forex, you have what's called the first in, first out rule. If you have two trades that have the exact same unit size, you're not allowed to sell any trade except the oldest one. So the dirty trick to that is go slightly above or slightly below. It's a simple way of getting around the process, and it helps you mitigate your risk. So we're going to take care of that. And it looks like we lost money. We hit our stop loss. No big deal. That's what the practice account is for. So a 10 to 10 didn't work. Now, if you studied any amount of time with numbers, then you know that smaller numbers happen more frequently than larger numbers. But again, trial and error. Let's see what happens. Let's try it again. Let's try a 10 pip. And let's see what happens when we try a 20 pip stop loss. Now this is what's called an upside down risk to reward. That is, you have more risk than reward. You're risking $1.20 to make 60 cents. There's good and there's bad to that. You'll learn as you read and as you practice. That's the important part. As you practice, try it. See what happens. Statistically, though, you're more likely to travel a shorter distance than you are a longer distance. So let's submit this and see what happens. Remember, practice, try, experiment, watch how the market behaves. That is really what trading is all about, is your abilities to watch the market, to observe the market, and to see what happens. So hopefully this will help you and encourage you to get into trading. It is very fun, even if you just want to play with a demo account. It's fun to see how things really work. It's an enjoyable process when you have the right mindset. Please, if you have any questions, leave them in the comments. I do answer every single comment. If you have anything you would like to see for further videos, let me know. Please give this video a like. Help me help others learn just how fun trading can be. It's not about gambling. It's not about unnecessary risks. It's like any other hobby. It has a certain level of enjoyment to it. Thank you for watching, and until next time.